We have a client that is selling it's like a medical testing practice, and he's selling it for about 22 mil. And he came to us because his previous tax advisor told him there's really nothing he could do. And so he was referred to us through another client that we did some tax strategy for. And we took a look at the LOI from the buyer, and the LOI stated that they wanted to do a purchase that was based upon asset and stock, right? So when you sell a company, you can either sell it for all stock, that's basically just the value of the company. You could sell it for all of the assets, which is just the value of the tangible assets in there, or a blend of the two. And so when you looked at the LOI itself was stating that the offer was based upon stock and assets. Now the thing is, when you sell your company's stock, you pay a long-term capital gain tax rate, which is 20% plus a 5% or 5.3% Medicare kicker. That's like 25.3% altogether is your capital gain on the sale of this. And because it wasn't structured properly from the get-go, he wasn't qualified for the QSBS, and plus it was a young company anyways. We were looking at minimizing the capital gain on the backside. Now, the way it was structured was capital gain plus asset sale. Asset sale, anything that's been fully depreciated or certain assets, you recapture that at your ordinary income tax rate. This guy was at the top of his bracket, so he was at the 37% bracket. So I looked at it and said, well, can we negotiate with the buyer to turn this all into a stock sale as opposed to a stock and asset sale? And we went back and forth with the buyer, and were able to get terms with the buyer where they agreed to 100% stock sale at the same price. And because of that, on that sale, we were able to save the client, because it was a blend of stock and asset, we're able to save them $700,000 in income tax, right? Just because we had taken a look at the LOI, realized how it was structured, and said, hey, can we structure this differently? Can we move all of this into stock or more of it in stock? And because of it, now his entire sale is subject to long-term capital gain, as opposed to a combination of long-term capital gain and ordinary income tax. So it's like things like that of looking through it. And, not a lot of tax advisors experience this with their clients, help them through exit. And the fortunate thing is we've helped a number of clients through exit where we could see these things and we could understand what we could do. The second thing that his previous preparer didn't notice was he provided company loans to the company to allow it to operate in the first 2 years that he never got repaid back on. So that previous tax professional thought that those loans would just disappear and he'd pay tax and everything. And instead, what we did is we structured it on his back end, where when a company gets sold, he gets repaid the loans, which becomes tax-free to him because it's a repayment of capital he provided to the company. And then the rest of it, we would figure out the tax from. So just those two things alone, the stock asset sale switched and also the repayment alone, we saved them about $850,000 in taxes at the end of the day on this $22 million sale of a business. So that's substantial, right? That was a lot of money. And I told him, hey, we're saving this much money. Do you have a favorite church or charity you like to donate to? I suggest it's a good time to consider making a donation to your favorite church or charity. I'm a big nonprofit person, and I firmly believe that the money we give to the government, as much as I wish it would go to helping people in need and our favorite churches and stuff like that, it doesn't happen. So when I help clients save a bunch of money, I strongly suggest that they donate to their favorite church or favorite charity or favorite mission. And that way they're saving money from taxes and they're doing good at the same time.